Hi, very good morning to all, and welcome back to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin here. Today will be the Wednesday, the 15th of October 2025. So as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so as usual, let's have a quick recap of what has taken shape yesterday and as well as in today's early Asia session before the start of our daily dose at 11 a.m. Singapore time in terms of the relevant news flow, economic data release, and their respective impact on the movement of all those cross asset classes on the intraday basis that we covered on a frequent basis, right? That means, i.e., the 4 major US dollar pair, the 6 major stock indices, and as well as the 2 key commodities market, which is gold XAU/USD and West Texas crude oil, before we jump straight into the intraday technical outlook of all these 16 asset classes, 12 asset classes, pardon me. All right, so what has taken shape yesterday was very much driven on news flow pertaining to the trade tension, banks earnings release, which is the US banks earnings release that officially kickstart the Q3 US earnings season, and as well as Fed chair important public speech, right, that moved the market yesterday. So let's start with the trade related news flow first between the US and China. So what we see over here is that we know that last Friday, there's this downside volatility shock to the risk asset classes pertaining to a sell-off in the major US stock indices caused by a revival of trade tension between US and China, where Trump actually upped his rhetoric again, threatening to increase 100% tariffs on China products heading into US. Then thereafter, yes, on Sunday, he actually reversed his stance, he toned down a bit, and causes the US stock market to gap up on Monday. And yesterday, there's a bit of sell-off before the start of the US session, where the S&P 500 E-mini futures and the Nasdaq 100 E-mini futures fell around 0.8% during the European session. Why? Because China trying to actually play this brinkmanship between two of them. Bear in mind that these are all negotiation tactics. What I mean by negotiation tactics? Both parties trying to see which has a stronger hand in terms of playing. You know, when you play poker, which has a stronger hand, and both of them is trying to test each other trump cards respectively before the two leadership potentially meeting up at the end of this month in APEC or during the APEC summit in South Korea, and also ahead of that extended trade truce deadline that is due on 10th of November. So yesterday, China imposed this so-called shipping, we call it a sanction. This US China's, okay, let me expand my screen so that you guys could have a better view of the chart. Okay, I hope that this is large enough for you guys to see. Right, so yesterday, during the second half of the Asia session, I would say China sanctioned US units of Hanwha Ocean Company, a South Korea shipping giant, and threatened to further regulatory measures on the shipping industry. So basically, increasing shipping costs for US. Okay, over here. So this took shape. This news flow came during the second half of the Asia session. So i.e. that means when the European session kick-started, right, around 2 p.m. to 3 p.m. Singapore time, that causes the S&P E-mini futures and the Nasdaq 100 E-mini futures to slide, all right? And interestingly, at the start of the US session, things get stabilized after one of the key US officials that is involved in the US trade deal negotiation, which is the US trade representative Jamison Grill. So Jamison Grill mentioned that he actually made a remark saying that US and China resolving standout following meeting. So US trade representative predicted that heightened tension with China over export control would ease following talks between representatives from the world's two largest economy over here. So in fact, on Monday, senior level officials from US and Chinese government held discussion about recent tension, and Grill said that US has seen signs that China has realized that they overstepped in the recent government statements. So that actually offer a bit of relief to the US stock market, where the sell-off starts to stabilize in the after the US stock market session gets underway. All right, yesterday. And what's interesting over here, Trump trying to play punk again. So during the as we approach the second half of the US session, Trump made this hawkish rhetoric remark to play a brinkmanship. He threatens China cooking oil trade as retaliation for soybean boycott over here. All right, but net overall, most importantly, market participants pay close attention to the additional liquidity that could be injected into the US economy starting from next month and as well as into the early half of next year, 2026, by scrutinizing Fed Chair public speech yesterday. So Fed Chair made a remark saying that he signaled that the central bank may stop shrinking its balance sheet in the coming months to preserve liquidity in the overnight funding market. So we know that since 2 years ago, the Fed has started to kickstart its quantitative tightening program, reversing from its QE program that has taken shape since the great financial crisis, which is 2009 all the way up to 2020. All right, even it stretches much further over here. So since 2 years ago, it started to reverse this quantitative easing program. That means no longer buying long-term US Treasury bonds in the secondary market to push down the longer-term US Treasury yield. Instead, they do quantitative tightening. That means allow whatever bond purchase that they purchased in the past to expired without repurchasing them again. But they will slow down this pace of quantitative tightening in the coming months to preserve liquidity. And he also mentioned that labor market prospect continues to worsen, supporting investor expectation for another interest rate cut this month. So net overall, this is a rather dovish speech, public speech made by Fed Chair, indicating that high chance that the Fed will continue cutting its rates after kickstart its 2025 first interest rate cut in the September meeting, extending further rate cuts into 2026 as well, and expecting it to be much more dovish in 2026, especially when he signaled that the Fed may stop shrinking its balance sheet. Right, that means either pause or reverse its QT program. So that actually causes increased bets in the CME Fed Watch 2, taking into account of the price action of the Fed funds futures traders. High chance of 96%, 95% chance, 96% chance that the Fed may cut another 25 basis point cut to bring the Fed funds rate to 3.75% to 4% on the 29th of October meeting. And what's interesting over here is that the increase has been significant for the next few meetings. So how do I see that? By looking at the aggregated tab over here. All right, let me share you guys so hope you guys see the screen. All right, so we see big jump in the 10th of December 2025 FOMC meeting. So that will be the last meeting for the year. Previously, it was about 60%. About a week ago, that at the start of this week it jumped to 80%, and after yesterday Fed Chair dovish speech, or I'll say ultra dovish speech, it jumped all the way up to 94.5%. That's almost close to 100% that market participants are expecting a third interest rate cut to come in before 2025 ends to bring the Fed funds rate to 3.5% to 3.75%. I also wish to highlight that the betting odds, or the odds has increased for a much more dovish Fed heading into 2026, where we start to see almost 99% chance that the Fed will do the fourth interest rate cut on the 18th of March in 2026, bringing the Fed funds rate down to 3.25% to 3.5%. And overall, we see a 90% chance that the Fed will reduce the Fed funds rate much further on the last meeting for 2026 on the 9th of December to break down to 2.75% to 3%. So all you could see over here is that market participants are still pricing in 3 interest rate cuts for 2026, but all these 3 respective interest rate cuts, the odds of having these cuts has started to increase dramatically on the upside over here. All right, So even though 99% chance to break down to 3.25% to 3.25% to 3.5% on the 18th of March to 2026, and we have a high chance of 92% to break down further on the 17th of July of 2020, 17th of June, pardon me, 2026 FOMC meeting to break down lower to 3% to 3.9, 3% to 3.25% at a high chance of 92%. All right, so over here, what we could see is that the betting odds has starts to rise over here in the 2026. Three potential interest rate cuts that the Fed Funds futures traders has assigned to. So with this rising odds of the Fed being much more dovish by the Fed Funds futures traders, that created a positive feedback loop into the US stock market, where all three of them managed to reverse from their intraday losses at the start of the US session. Similar for the S&P, there's a bullish reversal over here on the NASDAQ 100 as well. Come on, let's go back again. Okay, give me a couple of seconds to refresh the charts. All right. Okay, similar for the NASDAQ 100 and as well as the Dow Jones Industrial Average. So net overall, what we could see is that all of them did a bullish reversal. It's only the fact that the NASDAQ and the S&P underperformed because there was a underperformance in the major semiconductor US stock yesterday. So that causes the NASDAQ 100 to still close in the red, but there is a big bullish reversal. That means initially NASDAQ and the S&P was down almost 1%, and their losses were trimmed off almost by 50% or more, depending on which indices you look at, and ended ended with a lower downside magnitude by the end of the US session. So the Nasdaq 100 closed negative 0.9%, the S&P negative 0.16%, whilst the Dow Jones up by 0.44% due to its heavy weightage on the Goldman Sachs, which actually ended the session very positively after a very strong Q3 earnings results. The Russell 2000, which is basking in the limelight of a much more dovish Fed, and I still recall that Russell 2000 is something to look out for, because as long as the Fed remains dovish and signal more interest rate cuts to come in 2026, especially the signaling of the potential reduction or even the removal of QT program, that could potentially benefit the Russell 2000 company much more instead. Why? Because the Russell 2000 component stocks, I would say that these companies rely on financial leverage to boost their business operation. All right, so hence the Russell 2000 outperformed yesterday by 1.38%. So this is what I mean by, if you look at the heat map of the S&P 500, yesterday's drag down was actually done taking or the positioning adjustment of NVIDIA and its fellow semiconductor companies over here, where NVIDIA is down by negative 4.4%, Broadcom down negative 3.52%. All right, that causes the drag on the S&P 500 and the NASDAQ 100 over here. All right, so if you look at the FX market, all right, as per se, so if you look at FX market, yesterday we see the dollar also abating as well. So the dollar actually sold off at the start of the US session after initially bouncing against the sterling over here. So the dollar actually rose against the sterling due to a rather weak UK labor market data that prompted the that rose the speculation that the Bank of England may kickstart its interest rate again in the next few meetings. So what do I mean by that? So you look at the economic calendar. Yesterday's the key economic data for UK unemployment rate actually rose more than expected, 4.8%. From 4.7% that was penciled in expectation, and also above the previous July print of 4.75%. And if you would look at the unemployment change, was also very weak, only added in 91k jobs added for August, way below the previous month July print of 232k jobs previously printed. But however, thanks to a much more dovish Fed chair speech yesterday, and that causes the dollar weakness to come into the US session. And as we are speaking right now, the weakest one of the weakest dollar pairing will be the dollar yen, which is down by negative, almost down by negative 1% based on the 5-day rolling performance, followed by the dollar CNH over here and the dollar Swiss. All right, all underperforming with the dollar index that is almost unchanged, whereas the dollar Swiss is down by negative 0.15%, and the dollar CNH against the offshore Chinese yuan is down by negative 0.27% based on the 5-day rolling performance. And with this dollar weakening against the Chinese yuan, or i.e. the Chinese yuan strengthening against the US dollar, that kick-started a recovery back into the Hang Seng Index. Again, despite that earlier, we call yesterday's late sell-off, the Hang Seng Index is up by 0.96%, almost 1%. The Hang Seng Tech up by 0.8%, and the HSCEI up by 0.9%. And the CSI 300, that's the benchmark of the China A shares, almost unchanged. All right, or we call it supported by the weakening of the dollar against the C and the offshore yen. So if you look at the 1-day rolling performance in the FX market, very clearly the dollar yen is actually underperforming against the other major currencies. So later I'll touch on the chart of the dollar yen. All right, over here. Then another news flow that is supporting this dollar weakness coming up from the situation in Europe. So we know that Europe in the last 2 weeks, there's this France political turmoil where the France PM resigned, and he was actually brought back again late last week. And yesterday he actually proposed to suspend French Prime Minister Sebastian Lecornu proposed suspending a law to raise the retirement age in a bid to bring political stability to the country. So with this proposal, that causes the euro to bounce off as well. And what's interesting is that it bounced off from our short-term pivotal support that we highlighted earlier on Monday. So later I'll touch on that particular chart as well. So very interestingly, with the dollar weakening over here, we potentially see a retracement of the dollar strength right off this upper limit of this potential ongoing symmetrical triangle range configuration that has been taking shape since the low of 1st of July. All right, so right now we start to see initially in the last 4 session, it tested 99.40, which is the upper limit of this symmetrical triangle range configuration that I drew from the high of 1st of August, this gray line over here. And right now there is a bearish reaction of it yesterday, which down negative 0.22% and have a negative follow through as we are speaking right now. The dollar index is down by negative 0.15%, also supported by this US Treasury 2-year premium shrinkage against the rest of the world. So if you look at this line here, is sloping downwards, the blue line. So this blue line is actually what I did is that I get a weighted average of the US 2-year Treasury yield minus a weighted average of the 2-year government bond yield against the major economies: Germany, UK, Japan, Canada, Swiss, AU, and China. So if this line is sloping downwards, it actually support dollar weakness. And right now, this 2-year Treasury yield spread versus the rest of the world is now coming to test a major support level over here. As you can see on my screen. So that also actually causes the dollar strength to react negatively at the upper limit of this ongoing medium-term potential symmetrical triangle range configuration that has been in place since 1st of July 2025 low. All right, over here. Okay, so with the dollar weakness coming in, gold price continues to remain rather strong over here, also helping silver to go up as well. So gold price continues to extend its gains for the 3rd consecutive session yesterday to print a fresh all-time high at 44,180 level, added in 0.8%, and in today's Asia session, it actually flashed a fresh intraday all-time high, breaching above yesterday 4,180. So now it's trading at 4,182. So later I'll share with you guys what are the key resistance level to watch and the key support level to watch on the intraday basis. So gold prices continues to run hot on the upside. as we basking on the limelight of a debasement trade. What I mean by debasement trade, that means distrust of the US dollar given the current situation of the White House administration policy, especially this ongoing US government shutdown, and as well as the dollar potentially weakening into 2026 after Fed Chair dovish signal yesterday. All right, over here. So with that, another particular news flow I want to share with you guys over here is pertaining to oil price. So oil price going to tumble yesterday after the break of that important medium-term range resistance of $60.55. So yesterday, the international agent, the IEA, I call it the International Energy Agency, said that record oversupply oil will be bigger than previously estimated, and the excess is already starting to build up in ocean going tankers. So with world oil supply exceed demand by almost 4 million barrels a day next year, an unprecedented overhang in annual terms, according to IEA latest monthly report. And given the fact that OPEC Plus continue to do production increase, not production cuts in the months ahead, signaling that oil prices will have this overhang. And I believe that whatever OPEC Plus is doing is very politically driven, given the fact that we know that US in the start of the year beginning to solicit Middle East investment into the US, and also what US White House wants is to have a rather weaker oil, lower oil prices to actually curb inflation situation in the US. So by curbing inflation situation in the US, lowering down I would say that forward expectation of inflation expectation, that could potentially allow the Fed to cut rates. So that is what the US White House administration want, a lower interest rate as well in the US economy. So what we could see over here is that this is being playing out in this very key intermarket dynamics that I like to share with you guys over here. Is this chart very quickly, an additional chart. So what I could see over here is that this dark blue line and the light blue line is actually the 5-year break-even inflation rate and the 10-year break-even inflation rate. So this break-even inflation rate is actually market driven. So take this as a market determined, not market driven, market determined implied forward-looking inflation expectation 5 year from today and 10 year from today from a component of the TIPS, that means the Treasury Inflation Protection Securities price. We take out from there, and TradingView is able to plot this. So the 5-year break-even rates, that means 5-year inflation expectation from today, has continued to slip down from 2.48% to 2.3%. And the 10-year break-even rates, that means 10-year inflation expectation from today, continues to slip as well, right now trading at 2.3%. So this slip down in both the 5-year inflation expectation and 10-year inflation expectation all came with a lower oil prices. So as long as oil prices continues to dip lower, potentially this 5-year and 10-year break-even inflation will continue to slip, and that could allow the Fed to continue cutting interest rate over here. So this is the Fed funds rate, and also lowering the 10-year 10-year US Treasury yield as well, that being a longer term interest rate benchmark in the US and globally. So net overall, what we could see over here is engineered, we call it inflation expectation, that what the US administration wants through the controlling of the oil prices. All right, very interesting at play. Right, so that potentially sum up the first segment of the daily dose. Yeah, before I move on to the second segment of daily dose, there's this important inflation data out from China. I want to highlight to you guys that yes, the headline number will be scarier, but if you dive deeper, there is no risk. The risk of deflation has started to actually tone down in China. Okay, what do I mean by that? Okay, so now this is inflation rate. All right, so this is the headline rate, including food and energy. So the inflation rate in China year on year, yes, it's scary. It's showing negative 0.3%, way much more worse than what market expecting is negative 0.1%. So market is expecting a recovery from negative 0.4% print in the previous month of August to negative 0.1%, but instead it actually came in worse than expected at negative 0.3% year on year. So if you look at the trend, okay, it actually decelerate back down, but come on. Oh, okay, give me a minute. Okay, so negative 0.8 actually slow down the pace slowed down from the previous month of negative 0.4, but it was worse than what market is expected. All right, so it's actually driven by food prices over here. All right, so but if you strip off the food prices, right, taking into account of the core, okay, give me this is the core inflation rate. Okay, so this is the core inflation rate, but in fact, inflation rate continues to increase in China gradually since March. All right, so right now, after stripping off the food and energy, the core consumer prices in China actually rose by 1% year on year in September, and is the highest reading in 19 months, following a 0.9% gain in August. So that actually implies that after stripping out the food prices and energy prices, the core inflation rate in China actually improved further. So that actually potentially reduce deflationary risk spiral in China, which is good. All right. So what China wants now is an upward move in inflation. So that could actually potentially increase business and consumer sentiment rather than a deflationary risk spiral. And if you look at input prices from China, which is production cost in China, indirectly by looking at the PPI. So PPI actually also further much improved. So previously it was at negative 2.9% year on year. For September, it came in at negative 2.3% within market expectation. So if you look at the trend of the PPI, the decrease, the downside momentum of the, come on, has started to improve since July print of negative 3.6%, August negative 2.9%, and September it improved further to negative 2.3%. So after diving back deeper, looking at the core CPI rather than the headline CPI, and the latest China production prices change, so that is considered as business input cost over here or factory gate prices. Deflationary risk spiral risk has indeed reduced in China, which is actually positive for the Chinese economy because that eventually could boost consumer confidence and business confidence, and indirectly creating a positive feedback loop into the China stock market and the Hang Seng indices, which is the Hong Kong stock market, given that both of them are hand in hand, moving hand in hand. All right, so that is the first segment of the daily dose. So let me move on to the second segment where I will cover all the 12 instrument intraday technical analysis outlook. All right, but before that, let me expand my screen, right, so that you guys have a better view of the charts. Okay, so let us start with the FX market over here, starting with the euro dollar. So like I mentioned, the euro dollar did a bounce right exactly at the pivotal support, which is the medium-term pivotal support that we highlighted on Monday, 1.1513 over here. So no change, continues to maintain that bullish bias as we now starts to trace out a potential mini intraday double bottom bullish formation over here. Right, let me highlight you guys. Okay, first bottom, followed by second bottom. All right, and the neckline of the bottoming formation is at 116.25, which is testing right now. So a breakout above 116.25, which is a potential intraday upside trigger, could potentially see further potential upside on the euro dollar to at least test the next intermediate resistance on the intraday basis, 116.50, followed by 116.90, which is a confluence of the 20-day and the 50-day moving average acting as a similar resistance area at 116.90. Only a bearish breakdown below 115.30 will invalidate this recovery scenario on the euro dollar to see a further weakness to expose the next intermediate support level at 114.60, 114.60, which is the former minor swing high of 31st of July, now turns into a intermediate pullback support if the 115.30 medium-term pivotal support give ways. So that's for the euro dollar. Next up will be the sterling pound. So despite the sterling pound sell off over here, that sell off managed to help right exactly a test, I would say that a challenge at the 132.65 short-term pivotal support before bouncing up. So this bounce is actually led by that Fed Chair dovish signal. I would say it's a much more ultra dovish signal during his public speech yesterday. So that managed to survive on the sterling pound or the sterling dollar against the USD. So still no change, still using 132.64 short-term pivotal support level, maintain that bullish reversal / recovery scenario for the sterling dollar. First resistance level to watch 133.90, followed by 134.40, 134.65, which is a confluencing with the downward sloping 20-day moving average. So these are the two resistance level to watch for today as we maintain that bullish bias / bullish reversal recovery scenario for the sterling pound. Only a clear bearish breakdown below 132.65 with an hourly close below it, that would see further weakness on the sterling dollar to see a further slide to test the medium-term pivotal support zone and as well as the 200-day moving average, all confluencing at 132.10, 131.70. That's for the sterling dollar. Next up will be the Asia Pacific currency against the dollar, which is starting with the Aussie dollar over here. So the Aussie dollar, very interesting over here, is that it also challenged our short-term pivotal support level, doing a slight dip below it before doing a bullish reversal at the start of the US session. So this slide of the Aussie dollar was more related to the China US tension trade flow, US tension US-China trade tariff tension news flow. Then thereafter, it managed to shape that bullish reversal, giving this as a failure bearish breakdown. After that, we start to see a bullish divergence on the hourly RSI as well, indicating that the bulls are still in control for the Aussie dollar. So tolerate a bit of excess yesterday to that intraday low of 64.40. All right, over here, let me slash it 64.40. All right, so still maintain that bullish bias / bullish reversal scenario for the Aussie dollar. Next two resistance level to watch out for on the intraday basis, 65.45 followed by 65.75, which confluence with the 20-day and the 50-day move, the 20-day and the 50-day moving average as well. However, a breakdown below 64.65 potentially will see a further slip down to to do a test on the medium-term pivotal support zone, which is 64.15 followed by 64 figure level that confluence with the expanding wedge range support that has been in place since 23rd of April 2025 low and confluence with the key 200-day moving average as well. So that's for the Aussie dollar. Next up will be the dollar yen. So dollar yen yesterday, we have two levels to watch. So in order to see a bullish conviction to have a squeeze up towards 153.65/90, 154.50, which is my major resistance level, it got to have an hourly close above a 152.45. But instead, it can't have an hourly close and starts to trade downwards and continues to see a series of lower high over here. All right, a series of lower high. So that actually totally kind of eradicated my bullish bias and also now breaking below the 151.15 key minor short-term support level as well. So with that, I will flip to a intraday bearish bias view for today on the dollar yen. So with two resistance level to watch, number one will be the failure of this minor swing low that was in play since this Monday that got broken down, now turns into intermediate pullback support, intermediate pullback resistance level, given the fact that the hourly RSI has dipped into the oversold region, but so far there is no bullish divergence. Okay, there's no bullish divergence. So whatever bounces over here, I will fake the bounce and flip to a bearish bias instead. First level to flip the bounce will be at to fake the bounce will be at 141.70 level, followed by the critical key short-term pivotal resistance that I have for today at 152.45 that the bulls got rejected since Asia session yesterday. All right, and shape a lower high during the start of the European session, during the start of the US session, right? This high lower than this high. So whatever bounces, I will fade it using 152.45 as my short-term pivotal resistance level. Next, and flip to a bearish bias intraday stance for today on the dollar yen. Next, support level to watch will be at 150.50, followed by 149.80, which confluence with the rising 20-day moving average. All right, over here, only a bullish breakout and an hourly close above 142.45 will flip the honors back to the bears again to see that residual push up to test the next intermediate resistance at 153.65/90, maximum the major resistance zone at the major resistance level at 154.50. So what's 154.50 again? a couple of Fibo extension level, and as well as graphically this major descending trend line that have kept previous bulls in check since the major swing high of 3rd of July 2024, where BOJ under the instruction of the Japanese Ministry of Finance came in and sold the sell dollar and buy back the Japanese yen at that point in time. Right, so that's for the dollar yen. All right, now flipping our attention to the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. Still recall that we do have a pivotal support level at 25,140. So this support level came down and did a bullish reversal yesterday. So this is the gap up support that's being formed on Monday. So still no change given that price action can't break above the first intermediate resistance zone at 25,860, 26,060. But however, momentum has started to improve by shaping a series of higher low on the hourly RSI, as it's now trying to actually trade back up above the 50 level mark over here. Okay, so still no change. Pivotal support will remain the same, given that it hasn't broken above the first resistance zone of 26,060 over here. So still maintain that bullish recovery / bullish reversal bias on the Hong Kong 33, using 25,140 as my short-term pivotal support level. Above 26,060, potentially seek out the next intermediate resistance zone of 26,450, 26,570, which confluence with the 20-day moving average as well. Only a bearish breakdown below 25,140 will see the continuation of this corrective decline sequence, exposing the next near-term support level at 24,820, which is the swing low area of 28th of August. Failure to hold 24,820 will see a deeper corrective decline to expose the 1st of August medium-term swing low at 24,260 next. So that's for the Hong Kong 33, representing the Hang Seng Index, still maintaining that bullish recovery / reversal bias, using 25,140 as my short-term pivotal support. Next up will be the Japan 225, representing the Nikkei 225. So for sure, the Nikkei 225 managed to survive right exactly at our pivotal support that we mentioned on Monday, 46,540, and did that bullish reversal area as well. So right now, it managed to clear that resistance zone, now turns into a pullback support level to watch over here, 47,002. So two support level to watch, 47,270 in any minor pullback. As long as this minor pullback didn't surpass below the all-important short-term pivotal support that got survived yesterday at 46,540, we continue to maintain our bullish recovery / bullish reversal bias on the Japan 225. Next two resistance level to watch in first step will be 48,195, followed by the all-time high area at 48,860, 49,070. Only a bearish breakdown below 46,540 will negate this bullish reversal scenario to see a another round of choppy minor corrective decline to revisit the gap up that was being formed on Monday at 45,855. There also confluence with the rising 20-day moving average as well. All right, next up will be the Germany 30, representing the German DAX over here. So the Germany 30 came down, it slid down, but managed to survive right exactly at the 50-day and the 20-day moving average over here, and also confluence with this former congestion area, now turns into a pullback support. And if you were to look at the Fibo retracement, taking into account of that previous impulsive up move sequence that kickstarted on 25th of September after this corrective decline sideways movement, all the way up to the high of 9th of October before that corrective decline takes shape, that confluence with the 50% Fibo retracement over here, and the 61% will be the medium-term pivotal support at 23,900 level, which is also this minor swing high area of 5th of September and 1st of October, where the price action did a bullish breakout. Okay, that kickstarted the former impulsive up move sequence. So tolerate a bit of excess what happened yesterday, given the fact that we do have a bullish divergence that's being seen on the hourly RSI. So given the fact of this bullish divergence and where the price action bounced, there is no there is less conviction to play a bearish move to test the 23,900 medium-term pivotal support level. So instead, I will tolerate a bit of excess at 24,090, 24,045, given the latest development positively that has been formed on the key elements that I shared with you guys earlier on. So still maintain that bullish bias using 24,090 adjusted, 24,045 adjusted short-term pivotal support. Two key resistance level to watch on the intraday basis will be 24,550 followed by 24,650 level. Okay, this intermediate resistance zone over here. However, if you start to see a price action breakdown below 24,045, then this corrective decline will extend further to test the medium-term pivotal support level, and as well as the 61.8 Fibo retracement of that previous impulsive up move from the low of 25th of September and 9th of October at 23,900 next. So that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 managed to do a bullish breakout above this first resistance zone that we highlighted yesterday before it came down and managed to help at this level over here. All right, so with that, let me do a bit of adjustment over here. So this one here, taken out. So now this will be a pullback support level to watch for today. At 46,250 level, 46,250. Okay, so my short-term pivotal support level will be this minor swing low area over here. Also correspond with the rising 50-day moving average as well. That will be 45,710. So do a bit of adjustment, 45,710. Okay, so this will be my short-term pivotal support. All right, so a bit of adjustment over here, as long as any minor pullback didn't surpass below 45,710, but overall it's positive given that price action now managed to clear above the 20-day moving average as well. So next resistance level to watch will be 46,920, the minor swing high area of 6th of October and 7th of October before surging to a fresh intraday high at 47, fresh all-time high potentially at 47,160, which is a Fibo extension cluster level. Only a bearish breakdown below 45,710 will negate this bullish recovery bias view to see another choppy corrective decline sequence unfolding, retesting last Friday key minor swing low area at 45,190. So that is for the US Wall Street 30, representing the Dow Jones Industrial Average. Next up will be the SPX 500. So the SPX 500 managed to survive exactly at the medium-term, short-term pivotal support that we highlighted on Monday, 6,570 level before it bounced. But so far, it can't clear above this 6,690 level / 6,700. I will not want to tighten my pivotal support level to be so tight at 6,620. So still maintain the same levels so far. Still maintain that bullish recovery / bullish reversal bias scenario using 6,570 as my short-term pivotal support. Unless we have an hourly close above 6,690, then I will tighten my short-term pivotal support to 6,620 level. So after 6,690, the next resistance level to watch will be the 6,730, followed by the current all-time high area at 6,770. Only a bearish breakdown below 6,570 will see a choppy corrective decline sequence unfolding, invalidating the bullish recovery scenario to retest last Friday minor swing low, and so a critical level because that is my medium-term pivotal support area at 6,506 / 6,500. So that's for the SPX. Next up will be the Nasdaq 100 over here. So the Nasdaq 100 also can't have a proper bullish breakout above 24,795 before it dipped down and retest again the gap support level that we highlighted on Monday. So this will be my pivotal support level at 24,290. Unless we have a clear bullish breakout and an hourly close above 24,795 during the US session, then I will tighten my pivotal support level to 24,565 again. So however, price action still remains the same above 24,795. during the US session, and hourly close above it. The next two resistance level to watch on an intraday basis, 25,030, followed by the current all-time high area at 25,225. Only a bearish breakdown below 24,290 will invalidate the bullish reversal bias scenario to seek out another test on last Friday minor swing low area at 24,000. Maximum our medium-term pivotal support coming in at 23,870 on the Nasdaq 100. So still maintain that bullish bias on the Nasdaq 100. All right, so that sum up all the intraday technical outlook on all the major stock indices. Lastly, let's now proceed to the commodities asset classes, starting with the gold XAU/USD. So gold exactly bounced off our first support level yesterday at around the 4,110 level. Notice that this bounce, nice bounce, and hit our first resistance level as we're speaking right now, 4,184/4,189. Hourly RSI continues to remain bullish, continues to be helped by this parallel ascending trendline support as it continues to actually bounce back up to the overbought level again. So unless we have a clear hourly close thereafter, above this 4,189 level, because right now it's just testing on an intraday basis. So if we could have an hourly close at 4,189, then I will shift my pivotal support level to 4,107, all right, over here. So for now, still maintain the same at 4,056, which is the former all-time high area that was taken out on last Friday. Still maintain that bullish bias. Next two intermediate resistance zone to watch, which is a bunch of Fibo extension cluster level that will be at 4,240, 4,252, followed by 4,311, 4,330, as it continues to be on the path of a bullish acceleration. So if we do a much more steeper ascending trend line, ascending channel, I would say over here, let me move it. Okay, the next resistance, the upper limit of this will be at 4,240/4,252 as well. All right, so still maintaining that bullish bias. Still using 4,005 as my short-term pivotal support, unless we have a clear hourly close thereafter above 4,189, that I will tighten my short-term pivotal support level to 4,107. Okay, for now, only a bearish breakdown below 4,056 will invalidate the bullish acceleration scenario and see another round of corrective decline sequence unfolding, exposing the next two support level at 4,011 for 3,943. All right, level. All right, so if price action comes back close to this level again, I'll be on the lookout for any bullish reversal candlestick to flip the bias back into the bullish side of the story, given the fact that its medium-term uptrend phase still remains intact, as it continues to hold above the 20-day and the 50-day moving average over here. So that's for gold XAU/USD. Lastly will be the West Texas oil. So West Texas oil continues to tumble and hit our first support level at 58 over here. And right now it is attempt to actually go back up and can't break through our intermediate resistance over here, where the gap support has been invalidated at 58.97. So with that, I will tighten my pivotal resistance to be slightly lower today at 60.55. So as long as any bounces didn't break above 60.55, I will still maintain that bearish bias on West Texas oil, and price action now very clearly trade below the 20, 50, and the 200-day moving average. So next intermediate support level to watch after 58 figure level will be 56.80, which is a one-time Fibo extension on downside, and 56.80 graphically is also the minor congestion area of 5th of May and 6th of May over here. All right, only a bullish breakout above 60.55 will invalidate the bearish bias for today and kickstart a mean reversion rebound back into the 20-day and the 50-day moving average again at 61.80, followed by 63.30, which confluence with the downward sloping 50-day moving average. So that's for West Texas oil, and as well as summing up all the intraday technical outlook of all the broad-based cross asset classes that we cover. So let us now proceed to the third segment, the daily dose, which is what are the key events to look out for / data to look out for today. So for today, the economic data to look out for during the European session, there will be a couple of ECB and BOE officials speaking that could move the euro dollar and the sterling dollar, and as well as the respective FX crosses. ECB Gundos will be speaking at 3:40 p.m. Singapore time, followed by 4 p.m. ECB Botch will be speaking, and BOE Ramsden will be speaking at 4 p.m. Singapore time. And we have the industrial production out at 5 p.m. for Eurozone, where market is expecting a much more disastrous print of negative 1.6%. right? So that could influence the euro dollar, the euro crosses, and potentially the Germany 30 index as well. Then as we approach the US session over here, so given the fact that the US is still shut in terms of the government shutdown, so no key official US data may be released over here, so it will be a rather quiet US session, all right, over here. But we have one ECB official speaking, ECB Donnery at 10:15 p.m. and Bank of England official Breeden will be speaking at 11 p.m. So then after that we have a couple of so basically it's a slew of US central bank officials speaking from 12:10 a.m. all the way up to 1 a.m. Fed Bostic, 12:10 a.m. 12:30 a.m. Fed Moran, and 1 a.m. Fed Wheeler speaking over here, and followed by 2:30 a.m. We have Fed Schumach speaking. All right, so a slew is more of a key ECB, Bank of England, and US Federal Reserve official speaking today. And one particular news event will be the continuation of the Q3 earnings season to kickstart over here. So let me share with you. There is actually two banks reporting. Okay, 1 second. I think let me open up 3D Economics earnings calendar. So I'm not sure why the earnings tab is disappeared on the website. Okay, let me open up. Okay, so today, before the start of the US session, we have two more major financial institutions reporting their Q3 numbers. Bank of America, followed by Morgan Stanley, that could potentially influence the Dow Jones and the S&P 500, given that they have a higher weightage inside this the financials has a higher weightage in the financial sector has a higher weightage in the S&P 500 and the Dow Jones Industrial Average. All right. So with that, that sum up today's Daily Dose of Market Insights, a longer session, given the fact that there's much more things to cover. And I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.